So should you vary your risk when trading? Should you take on more risk on some setups than others? The answer might surprise you, so stay tuned. Trade risk is an old age debate, and there are several traders on both sides of the coin. However, a systematic way of varying your risk will improve both your bottom line and your equity curve characteristics, and there are 3 critical reasons as to why. Reason number 1, unless you trade only one security, what you buy or sell will not always have the same volatility, so it simply does not make sense to take on the same risk on a very volatile asset as compared to an asset that has very steady price fluctuations. It wouldn't make sense to have the same risk on something like a leveraged ETF compared to something like Berkshire Hathaway. Reason number 2, your trades are not always going to have the same stop loss distance from your entry. Think about it. Would it make sense to have the same risk percentage for a trade with a 200 basis point stop loss compared to one with a 50 basis point stop loss? You should consider reducing your risk when the stop loss distance is lower, because although the expected value of the trade is not necessarily lower, there's an increased risk of having a string of losing trades. Reason number 3, your strategy is not equally robust in all market conditions. It's simply not going to perform the same in a trending environment as in a ranging environment. And even if you design your strategy in such a way that shifts based on market conditions, it's going to simply be dead wrong sometimes. So by reducing your risk when you encounter a drawdown, you could potentially limit or reduce the system's drawdown. When your equity curve starts climbing again, this may be a sign that your system and the market are aligned, and you would return your risk back to your standard risk amount. So I hope these pointers on risk were helpful. If you like this kind of content, please leave us a like, and I'll see everyone in the next video.